Welcome to the July 26, 2018 Income Millionaire Insider Update. The market reversal radar, which we turn to see the high odds opportunities to find where the rest of the stock market is making mistakes by being either overly fearful and selling after prices have already come way down, or by being overly happy and buying after prices have already gone way up, is not signaling a high odds opportunity right now because we never reached a fearful extreme. Here in the shorter moving average of those underlying mood swings, which again are no different than the mood swings in your own household, they never became overly happy, although, they got close. And they only then came down to a point of neutrality, the middle of the road there, before popping up again, at least in the very short term. So no high odds opportunity there. Looking at that longer moving average, it moved down towards fear, but also never got overly fearful. I drew that horizontal red line from where we are now to show you all of the other times in the past 12 months when the underlying stock market mood swing was more fearful than it is now. No doubt the line has moved up in the last 2 days. I get that, but I can't say in good faith that I trust the upward movement as of this point right now, although anything can happen and we can be wrong. But let's protect ourselves in case the markets do come down in the very short term. I'm talking tops of a week here. We've talked a lot about ABVI. The ticker is ABBV. Talked a lot about ABVI in the last 2 months on everything we do here at the MoneyMan.com. ABVI, of course, makes Humira, the best-selling drug in the world, which represents about 60% of ABVI's earnings, which no doubt is a very high percentage of total sales. Thankfully, Humira is under patent, at least in the United States here, until the year 2022. Other companies are trying to create what's called a biosimilar for Humira, which just means a generic drug for a biotechnology-based medication. The U.S. government has recently submitted some paperwork to the president to pressure these big drug companies, just like ABVI, into not being able to make various deals with these biosimilar companies, trying to make these biosimilars by paying them off to delay the release of the biosimilar drug, or forcing them to make some kind of payment back to ABVI if they do produce the biosimilar, which the government is arguing raises the prices of medication through lack of competition, which may absolutely be true. Earlier this week, Citron Research sold the stock short at the height of happiness in the stock market mood swing, and they did a great job of timing that mood swing's reversal, while at the exact same time tweeting that ABVI may be the next big drug short because Citron Research thinks that these possible new rules will become law and ABVI's earnings will fall short even before the patent runs out. We could absolutely be wrong, but we don't believe that a Republican-led government will impose these regulations because these drugs cost billions of dollars to bring to market, and they don't want to stifle the progress and research by cutting the profits these companies make. On top of that, ABVI also has developed over time brand loyalty with all of the doctors and patients who have used their products for years, used Humana for years, and might not choose, at least in the shorter term, to switch over to a biosimilar even if one was available. And on top of that, insurance companies sometimes take a while to convert over and cover the biosimilar drug in their insurance plans. So again, sometimes even if the biosimilar is available, it's not covered underneath insurance for quite some time, which of course makes all those doctors and patients stick with ABVI for even longer. Assuming you own ABVI stock or call options here, Here's how to protect yourself if Citron Research has more success on shorting AbbVie. With the stock at about $93 a share right now, we can sell the September 21st, 2018 call option with a $97.50 strike and make at least $215, or about 2.3%, in only 2 months when compared to buying 100 shares of AbbVie stock in the open market, which would cost about $9,300. Then let's use that money to buy an AbbVie September 21st, 2018 put option with a $90 strike price for about $246. So I'm buying that protection on my AbbVie stock in the form of a put option for next to nothing, because we're taking in $215 and we're spending $246. Again, this is in case Citron Research is even more successful in driving down the price of AbbVie stock, and that is how you use your brains to get a better deal. So let's protect our AbbVie stock and options by selling that covered call, and then more or less buying our protection for free here for about almost nothing. So with the stock at about $93 a share right now, I would love to sell them my stock and options at $97.50 on September 21st, 2018, which is the options expiration that we're on right now here. We can see we can instantly make about $225 or 2.5% in only 2 months in the meantime as we wait. So let's start the transaction here, $97.50 strike price, and we want to sell this covered call. Again, this is assuming that you already own AbbVie stock or a LEAP. So we will sell at the bid price. Populates up here. Yes, I would love to sell one AbbVie September 21st, 2018, 97.5 call strike price, because even if it does get called away at that price, we're making a lot of money. If it doesn't get called away, that premium is ours forever. So we'll hit transmit. And there we go. We just sold that covered call and instantly made $222, and that's about 2.4%. So now let's go use that money and buy the protection, buy our put option. So here we go. We are still on the September 21st, 2018 options chain. We're now looking at the $90 strike. Right here is our protection, and this option, it's going to cost us about $232 max to buy this, but that's okay because again, we're getting it for close to nothing. So we're going to buy a little protection here in case our AbbVie stock does get even lower than $90 a share and Citron Research is successful in shorting this stock and driving the price down even more. So again, in this case, we are buying this put option. So we're going to click on the ask side of things here. And we hit transmit. So yes, I want to buy one AbbVie September 21st, 2018, $90 put option. This is our protection. This is our insurance. So I hit transmit. And there we go for almost free, because we made $222 on the other option. For almost free, we paid $231 for that September 21st, 2018, $90 strike price. Doesn't get any better than that. Celgene, ticker CELG. Celgene is getting to be a really good deal now. Celgene is the maker of Revlimid, a treatment for multiple myeloma, which is a horrible blood cancer. Celgene has the largest drug pipeline in the industry and may have more blockbuster drugs coming up soon here. The earnings per share are growing this year at almost 110%. Profits may grow at 20% a year for the next 5 years, and right now the stock is only selling at about 8 times forward earnings, which is very cheap. Why? Because people are concerned and are getting emotional about the stories that they're reading about Celgene. Celgene bought a company with a very important cure for cancer that was in the development stage, and the Food and Drug Administration rejected the research that Celgene's sister company submitted as part of the ongoing approval process. Now, here's the important part. Not because the drug was ineffective, but because the reporting and submission were done so poorly by the sister company. Absolutely, this makes Celgene look bad, no doubt, but again, the FDA rejection had nothing to do with the effectiveness of the drug, which in my eyes is a positive. Many people aren't doing their research to figure out the details and have been selling the stock because they think the drug is no good, which is not the case, as we've explained. So here's another place to take advantage of the folks that don't know the facts of the situation and are only following the trend of a chart. The last time Celgene was down around $88 a share was back in 2014, 4 years ago. In 2014, Celgene's sales were about $9.60 a share. Today, again at about $88 a share, the sales are worth about $20 a share, and we believe the company is absolutely worth buying right now. Instead of buying 100 shares of Celgene in the open market and spending about $8,800 or a little more, let's look instead at buying the January 17th, 2020 long-dated call option, or LEAP for short, because for now there is somewhat of a pricing mistake that we could take advantage of. Notice the price difference between the slightly in the money $85 strike and the $10 in the money $75 strike, which of course naturally is $10 more in the money, but it's only costing us an additional $7, which is no different than paying someone $7 and getting a $10 bill in return. I'll do that all day long. I'd also much rather pay about $2,200 for that LEAP option rather than about $8,800 or a little more to buy 100 shares of the stock outright. That's saving us about 75% of our cash that we can keep in our pocket and go out and do other deals with. But now let's continue using our brains, get a better deal. Let's rent out our stock that we just bought in the form of that long-dated option. Let's rent our stock out to emotional investors by looking at the August 17th, 2018 options chain and seeing that we can make about $90 in less than 30 days for selling the out-of-the-money $92 strike. If the option expires worthless on August 17th and Celgene stock never gets over $92 a share, which is a 5% increase in less than a month, then I'm happy because I can just write another call option, I can sell another call, and make even more money. If Celgene stock does finish higher than $92 a share by August 17th, I'm still happy anyway because the stock will have increased by 5%, which means my LEAP option could easily be up about 25% if it does get called away from me. So either way, we're very happy, we're winners. So instead of buying 100 shares of Celgene stock in the open market and paying about a little less than $8,900, let's look at buying the January 17th, 2020 call option and notice the pricing mistake between the $85 strike and the $75 strike. So looking at the ask side of things, where you have the 85 strike highlighted right now, and that is $15.60. When we go $10 in the money to the $75 strike, in theory, it should be $10 more. It should be $25.60, but it's only $22. So we are paying about $7 and getting $10 in return. I love it. I will do that all day long. I'd also rather spend about $2,200 for the leap option rather than spend $8,800 for buying the stock outright, saving us instantly about 75% on our cash. So let's buy that leap here, that $10 in the money 75 strike leap for $2,200. Press the ask side. Populates up here. Yes, I would like to buy one Celgene January 17th, 2020 75 strike call option, that leap option, and save myself $75 rather than buying 100 underlying shares otherwise. So we'll hit transmit. And there we go. We just saved ourselves about 75% of our cash by buying that leap for only $2,200. Well, now let's rent out our Celgene stock that we bought via that leap option by looking at the August 17th, 2018 options chain and making about $78 here with the click of a button in less than 30 days by selling that 92 strike, right? The spread is so small, we will simply click on that bid side, the sell side, to start this transaction. Yes, I would love to sell one Celgene August 17th, 2018 $92 strike price call option because I would love it if the price went up that high in only the next 22 days and we got to sell our stock for even more money. So I'm going to hit transmit. And there we are. We just made $77 by selling that August 17th, 2018 call option. Honeywell International, ticker HON. Honeywell is a very diversified technology and manufacturing company. It's in the aerospace sector. It's a supplier of products, software, and services to original equipment manufacturers. It's in the home and building space and deals in the process of technology and automated solutions. We like the software that's being developed right now, and they're also very big in the Internet of Things. This is, gadgets talking to each other wirelessly. Honeywell stock is no higher today than it was in December of 2017, and this may be a good time to create a partnership with Honeywell, especially seeing that there's a bit of an anomaly happening right now, and we can buy the January 17th, 2020 long-dated call option, again, a leap, at that $135 strike price. That's $20 in the money, but only pay about $14 for it. So again, we're paying $14, but getting $20 in return. So we're getting it at a 25% discount. We're also only spending about $3,200, a little less, to buy that option versus paying about $16,000 to buy 100 shares of Honeywell stock. So we're saving 80% of our out-of-pocket expenses to acquire the stock. Let's put some money back in our pocket by selling the Honeywell September 21st, 2018 $165 strike call option, again, to those emotional investors that are purely gambling and make a little more than $100 per contract with the click of a button, which is more than a 3% return we're instantly making over the next 2 months. We can potentially make this covered call trade 6 times each year, potentially making almost 20% annualized. We're converting short-term speculators into a better life for ourselves is what we're really doing. Let's buy that January 17th, 2020 leap option on Honeywell here at that $135 strike price. Now notice that $135 is $20 less than $155, so we are $20 in the money, although when we compare what we need to pay between the two strike prices, when we compare between $31.55 and $18.35, even though we're going $20 in the money, We're only being asked to pay $14 more for it. So this is a great deal, and I love this. We're only spending about $3,100, a little more than $3,100 here to buy this leap, rather than paying $16,000 to buy 100 shares of Honeywell stock, saving us about 80% on our money, on our out-of-pocket expenses here. So let's start this transaction. We're buying the leap, so we'll click on the ask side of things here. It populates up here. And it asks us all over again, do you want to buy one Honeywell January 17th, 2020, 135 strike call option? Yes, please. I will hit transmit. And there we go. We only paid $3,155 to control 100 underlying shares of Honeywell stock, saving us about 80%, because if we bought Honeywell stock out in the market, we would have paid $16,000. Well, let's put some money in our pocket now by selling that September 21st, 2018 options chain here in Honeywell. And we're looking at the $165 strike call option. Again, this is a covered call. And we can make a little more. Well, we can make about 107, maybe 108 bucks on this in the immediate term, which is more than 3% with the click of a button. Now, we may be able to make this trade 6 times in the next year, which would be about 20% annualized return on this covered call. It's a beautiful thing, so let's start to sell it. Again, we're looking at that 165 strike. Fairly close spread here. We will hit the bid side to start the sell process for this call. We hit transmit. And yes, I would like to sell one Honeywell September 21st, 2018, 165 strike call option. If you would like to sell more of these and make more money, by all means, go ahead. We will hit transmit. And there you go. We just made 104 bucks, about 3% with the click of a button. Again, annualized, we can do this trade about 6 times. Potentially make a lot more money here, potentially almost 20% a year on our money, and that is a great deal, again, because we only spent about a little more than $3,100 to buy that Honeywell leap. We hope you enjoyed this July 26, 2018 Income Millionaire Insider Update. As always, these are our thoughts, and this is not investment advice. Please seek out professional help if you need it. We'll see you next week.